Understanding jobless claims, an essential economic indicator. Jobless claims are a vital statistic in understanding the health of the U.S. job market and, by extension, the economy itself. Reported weekly by the U.S. Department of Labor, DOL, jobless claims measure the number of individuals filing for unemployment insurance benefits. This metric can be a powerful indicator of the economy's direction, with two main categories: initial claims and continuing claims. Key takeaways. Jobless claims show employment status. They indicate the number of people who are unemployed and actively seeking work. Initial jobless claims represent those filing for assistance for the first time. Continuing jobless claims comprise individuals who are keeping their benefits due to ongoing unemployment. An increase in jobless claims typically signals economic distress, while a decrease points toward recovery. To smooth out the data's volatility, economists often examine the moving 4-week average. The significance of jobless claims. The weekly jobless claims report serves as a crucial tool for macroeconomic analysis. Each week, the DOL tracks how many new individuals file for unemployment benefits. This serves as a benchmark for the overall job market. A rise in jobless claims suggests that fewer individuals have jobs, while a drop indicates a healthier labor market. Economic context. Jobless claims gained heightened attention during significant economic events, particularly during the COVID-19 pandemic. In March and April 2020, jobless claims surged to unprecedented levels. A staggering 30 million Americans filed for unemployment benefits as lockdowns and social distancing measures were implemented. The unemployment rate reached a staggering 14.7% in April 2020. Since then, there has been a noticeable recovery, with the most recent data indicating 233,000 initial claims in early August 2024 and a continuing claims figure of approximately 1.875 million. How jobless claims influence financial markets. Financial markets closely watch the initial jobless claims report due to its implications for economic health. Generally, if the initial claims are higher than expected, markets may react negatively, reflecting loss of confidence in economic stability. Conversely, lower than expected claims can boost investor sentiment, often leading to market gains. Market impact of reports. Analysts' forecasts. Analysts often adjust their market predictions based on expected jobless claims numbers. A significant deviation from these estimates can lead to market volatility. Timing is key. The report is released every Thursday at 8:30 a.m. Eastern Time, and this regularity allows investors to plan their strategies around its dissemination. The initial jobless claims report is a crucial component of broader economic assessments, serving as an indicator of consumer spending trends and overall economic health. The rationale is straightforward. When more individuals are employed, they have more disposable income, which drives personal consumption and contributes to GDP growth. The role of jobless claims in economic models. In addition to their immediate market impact, jobless claims are integral to various economic models and forecasts. For example, average weekly initial jobless claims form one of the 10 components of the Conference Board's composite index of leading economic indicators, which helps gauge future economic activity. Understanding employment terminology. To appreciate jobless claims fully, it's essential to differentiate between terms related to unemployment. 1. Jobless versus unemployed. According to the Bureau of Labor Statistics, BLS, unemployed individuals are those who are jobless, actively seeking employment, and available to work. Jobless may sometimes be used more broadly. 2. Types of unemployment. Employment issues fall into 3 main categories. Frictional unemployment, short-term unemployment resulting from transitions between jobs. Structural unemployment, long-term unemployment arising from shifts in the economy, like technological advancements that make certain jobs obsolete. Cyclical unemployment, unemployment linked to the economic cycle, rising during recessions and falling during expansions. 3. Eligibility for benefits, it's also critical to note that not everyone who is jobless may qualify for unemployment benefits. Individuals who voluntarily quit their jobs are generally ineligible for assistance. Conclusion: jobless claims are a crucial economic indicator with implications far beyond the immediate employment situation. They provide insights into the health of the economy, influence market movements, and help economic analysts forecast future trends. Monitoring these claims allows investors, policymakers, and economists to gauge the labor market's dynamics and make informed decisions based on the state of the economy. As such, declining jobless claims can foster greater consumer confidence and drive economic recovery, while rising claims signal challenges that need to be addressed.